What is credit? What does it represent? Why is it so important? Today we're going to talk about the impact of credit on your ability to get a mortgage loan. My name is Steve Saxton. I've been a mortgage lender for over 25 years. I've walked thousands and thousands of homeowners through this process. During that journey, I've learned a thing or two. There's a lot of misconceptions about credit, how it's calculated, how it affects your ability to get a loan. So we're going to dive into that today. If you're looking to get your first home loan, this is the video for you. If you're looking to step up and get a second house, this is the video for you so you can understand how that credit can improve your loan. So really, what is credit? It's very simple. Credit's nothing more than a 3-digit number that represents your ability to repay a debt. Anytime you have a debt that you've borrowed on, auto loan, credit card, mortgage, that creditor is going to report each month to the credit reporting agencies, and then they're going to generate this 3-digit score. The higher the score, the better the credit. In other words, you've paid on time for months, years, and your score will be higher. This score is what lenders are going to look at to determine if they want to borrow you money, because they want to make sure they're going to get that money back. So they rely heavily on your credit report. And really, if you're looking to get a loan, any responsible lender, the first thing they're going to want to do before they look at anything is pull your credit reports. This is why it's truly the foundation of getting your mortgage approval. So foundation is really what holds a home up. This is what holds your mortgage loan up. You have to have adequate credit. So when you look at a credit report, there's going to be 3 different bureaus. You're going to have Equifax, you're going to have Experian, and you're going to have TransUnion. So why are there 3? There's 3 because mortgage lenders are going to pull all 3. It's a tri-merge credit report, and they're going to take the middle of those 3 scores. Not the average, but the middle of those 3 scores. Now, this is different than if you go to your credit union or bank and apply for an auto loan, or you try to get a credit card. Typically, they're just going to pull maybe Equifax or possibly Experian. They're going to kick you out 1 score. If you've ever pulled your own credit, you've probably just seen that 1 score. Mortgage lenders are going to pull a tri-merge, so it's important to know that. These credit scores can range anywhere from 300 all the way up to 850, okay? Now, really, you can have poor credit, fair credit, good, very good, or excellent, and that's kind of the scale between 300 and 850. Now, most people, they're going to fall in this range, somewhere in the high 600 to low 700 range. It doesn't mean that they haven't paid on time. It may mean that they don't have a long history of paying, so their scores haven't had an opportunity to go up. In order to have a credit score up around 850, you need to have had credit for years and years and years. We'll talk about all the factors that go into that here in a moment. But really, in order to get a mortgage loan, you need to have a minimum of a 580 credit score. This is going to allow you to qualify for an FHA loan. Now, there's a lot of misconceptions or misinformation out there about not having to have a 580 credit score to get an FHA loan. There's a little bit of truth to that, but the reality is, if you've paid debts on time, you're going to have above a 580 score. And in order to qualify for a loan below a 580 credit score, there's certain other factors that it's almost impossible to qualify if you have below that. Now, anything between somewhere like a 580 and say a 670, this is going to be the range where you really are going to want to pursue an FHA loan. A lot of people think that FHA loans are going to be better than conventional loans, because when we talk about loan types, and this is a discussion for another video, but you've got FHA, VA, designed for veterans. You've got conventional, which is Fannie Mae and Freddie Mac. You've got portfolio loans and jumbo loans. But most people are going to qualify for either a conventional, probably 80% of people, or an FHA loan. Hey, I hope you're enjoying all this information about credit, but the truth is I'm trying to grow this channel. And if you're finding this information valuable, I'm going to be doing a ton more videos just like this about other things with the home buying process. So make sure to hit the subscribe button. Now, normally I would just throw an ad in here. There would be some advertisement, but I'm not doing that because I want to make sure you get subscribed. For now, let's get back to the info. So once you get into these higher credit scores, maybe 639, all the way up to 850, or maybe just in this range right here, which is where a lot of people tend to fall, you're likely going to pursue a conventional loan. Even if you're a first-time home buyer, conventional offers programs at 3% down. Now, FHA's minimum down payment requirement is going to be 3.5%. So really, FHA loans are designed for people with maybe a higher debt-to-income ratio, again, topic for another video, or lower struggling credit scores. But this is the range as to where your credit scores can fall. Now, what makes up that credit score? It's no surprise right here, payment history, or in other words, have you paid that debt on time? This is going to be a big factor, the number one factor, representing 35% of this score's makeup. But there's some other things that people don't understand. Credit mix. So credit mix, this is things like, do you have an auto loan? Do you have an installment loan? Do you have a credit card? Do you have a mortgage? All these different types of credit. This represents 10% of your score. So lenders love it when you're paying a lot of debts, and they're different types of debts, because it shows that you have the ability to pay all these different types of debts. Anytime you have like maybe just one credit card, there's only one account reported to your bureau, this is going to affect you because they like to see a credit mix. It's 10% of your score. Length of credit history, basically, this is how long have you had credit? 6 months, 12 months, 10 years. The longer the history, the higher the score. Again, that lender can see a track record, and the credit reporting agencies that are generating this 3-digit number, they can see a track record that you've paid on time for a long period of time. So regardless, if something happens in your life, maybe you have some isolated event that affects your finances, it's not affecting your ability to repay the debt. That's why they like having a long history of credit. 10% is new credit. Pretty simple. Have you acquired a lot of debt recently? If you have, you're going to see that negatively affect your scores. There's really nothing you can do about that, but it is a factor in your credit score. Now, here's the one I want to focus on. 30% is your amounts owed. Now, people, they're like, well, what does that mean? What this means is if you have a revolving trade line, something like a credit card, let's say, for example, you have a credit card with a high limit of $10,000. Anytime you owe more than 30%, this is important, more than 30% of whatever your high limit is, you're going to see it negatively affect your credit scores. So if you owe $10,000, or if you have a high limit on a credit card of $10,000 and you owe more than $3,000 or on that revolving trade line, it's going to negatively affect your credit scores. For this reason, you want to keep those balances as low as possible. What this tells the bureau is that you have the ability to charge, but you're choosing not to. It shows control. This is going to increase this 3-digit number with the bureaus because it shows that you have control, you have self-control. And this is actually one of the things that hurts a lot of first-time home buyers because generally they don't have a lot of credit depth. They don't have a lot of credit history. There's not a lot to look at. So they may go out and get like a department store credit card where they offer you 20% off to sign up for their credit card at like Old Navy or Lululemon or whatever, Costco. And so you have a $1,000 high limit on that card. That may be the only account that's reported to their credit, but they owe $400 or $500, $600 on this account that has a $1,000 high limit. They're seeing their scores tank. They may only have one account. They could have a 720 or a 740 credit score, but because they're carrying a balance on this card that has a $1,000 high limit, you're seeing it negatively affect their credit score because they owe more than 30% of the high limit on that card. So there's a couple of ways to combat this, but the number one thing you want to do is just make sure any revolving trade line you have, you're at 30% or less on that card. The second thing you can do, maybe you've got a Visa or MasterCard or an Apple card, which is really, really common, or an American Express, call that creditor and increase your credit limit. So if it's $1,000, bump it to $2,000. That way, if you owe, $500 on that card, you're only at 25% usage and you're going to see your scores go up. This is just a way to manipulate the credit system so that you can have the highest credit scores possible. But this is really common to first-time home buyers. So they don't have a lot of credit. Typically, the credit limits are really, really low. So call and increase that if you can. This is a typical credit report. I'm going to blow this up a little bit so you can see it. On this credit report, it's going to have all your information. This one's for John Doe. It's going to have social, date it was polled, date of birth. All of your personal information is going to be contained in this credit report. It's also going to show inquiries. It's going to show if there's any Social Security matches, red flags, anything like that. It's going to show if you have any collections. If you've had a recent bankruptcy, obviously that will be located on there. And it's also going to show if there's any fraud alerts or any triggers or red flags. So if there's a duplicate Social Security number or anything like that, that's going to be contained within your credit report. So kind of interesting when you start looking on there. And then it's going to go through all the different accounts that are reported on your credit. This is kind of the summary at the beginning of your report. You can see with this sample report here, $32,000 in revolving debt, which is a ton. But they've also got $6,000 in installments and then $775 other. This particular sample credit report is showing 15 revolving trade lines, again, which is a lot, 10 installment loans, no mortgages, no lines of credit, and then other 4 different accounts. It's going to show the length of the credit history, 20 years, 11 months, which is great. Average account age, 7 years, 11 months. Again, we talked about credit history and having a long period. This is a good example of that. Then it's going to generate some scores, which we won't go right into that. But it's also going to show some of your previous employment history. If other creditors have lent you, borrowed you money and entered this in, it's going to show this information right here. This comes from what's called the work number, which we'll go over here further in the report. So this is going to show all the different accounts. Now, we talked about having a credit mix. This is exactly what I'm talking about. Mortgage, it's going to list those. Revolving, installment, line of credit, and other. Mortgage, pretty simple. Mortgage loan. Revolving, this is going to be any credit card that you have. Visa, MasterCard, American Express. And then installment debt is something like a car loan, maybe a auto loan, or any kind of installment debt where there's a fixed amount that you borrowed and you're paying it back over 36 months or 60 months or 72 months. And then line of credit, this may be something like a home equity line of credit or a personal line of credit you have with your credit union or bank. And then other, this is similar to, or something like an American Express card where there's no set spending limit. You can spend as much as you want, but this has to be paid off in full each month, like a charge card, not a credit card, but a charge card. Credit reports love when you have a big mix and you have all of these different things. And you can see kind of how it breaks it all down. It's also going to have, again, your employment information, addresses that have been reported in the past, your current address. So any address that's been reported in the last 10 years is going to show on your credit report. So they have an address history. It just helps to like consolidate all your information so they can make sure they're dealing with the right person. So as you get into the report a little further, you're going to see it's going to list every single inquiry. In other words, everyone that's pulled your credit in the last 12 months is going to be listed. The date is going to be listed, and then who pulled that credit. And then there's going to be a code for each credit report that was pulled. Now, this is a common misconception with people. You can actually have your credit pulled numerous times in a 30-day window, a hard pull, not a soft pull, but a hard pull. You can have this done numerous times in a 30-day window, and it's only going to affect your credit score 2 points. They've done this so that consumers like you can go out and shop for the best auto loan. They can go out and shop for the best mortgage loan without being penalized because they're trying to get the best deal. So just remember that. You can have your credit pulled numerous times. If you're shopping for a loan, it's only going to affect you 2 points. That generally will rebound in about 3 months or 90 days. But the second thing is you can actually have a soft pull done. Now, if a lender accesses your credit doing this soft pull, it's not going to show up as a credit inquiry. They'll still charge the lender for the credit report. They'll still charge us, but it doesn't show up as a hard inquiry on your report. Now, anyone that comes to us on their first meeting will typically pull a soft pull so it doesn't affect their credit and get a general understanding as to what's contained in that report. Soft pulls aren't always 100% accurate. So if you're looking to put an offer in, if you're really looking to move forward on a purchase, immediately we're going to go in and do a hard pull because we want to know and have the facts of the credit report that we're going to use to qualify you for that debt. So if a lender has only done a soft pull, this could be a big red flag. It's okay for them to do it to get a general understanding of your ability to repay, But if you're going to put an offer in and have earnest money down on a home and move forward in a transaction, allow the lender to do a hard pull. You're really doing yourself a disservice if you're hard-nosed about it and don't allow them to pull your credit up. So enough about that. And then as you get into a report, you can see that every single debt that you've had over the last 10 years is going to be reported. And they're going to just show up like this. It's going to be contained in these columns. It's going to have all the information about that account. It's going to have the account type. This is an auto loan. It's going to have the date that it was opened, what the current balance is, what the scheduled payment monthly is. And then if you've had any 30-day lates, 60-day lates, 90-day lates, typically this whole area is going to be grayed out. You'll still be able to read all the info, but that allows the lender to it jumps out at them on the paper so they can see what accounts you've potentially been delinquent on. And then it just goes through typically your largest balances first and then goes on down. So you can see here, this is the second account that they have. Again, another auto loan, balance, and the scheduled payment on that. So we won't go through all the trade lines on this, but you can see number 3, number 4, number 5. It continues to go through those debts. Then down here, and this is something that's kind of cool now that technology has advanced, lenders will have the opportunity to access your employment data and do that electronically. There's a system called the work number, and we can actually pull your income. If the employer, and most employers do now, they report this data to this third-party service, so we can access your employment data and your income through these reports. This is owned by Equifax. You can see in this sample report, here's the income that this gentleman made, John Doe, back in 2019, and it's going to break everything down, 2020 and then 2021. And so it's kind of nice because you may not have to supply your pay stubs and W-2s if we can pull an automated report through the work number. So finally, as you get into the end of a credit report, it's just going to really summarize everything. It's going to say, is there any negative information, any charge-offs? Now, if you've seen a credit report for yourself, maybe from annualcreditreport.com or free credit report, it's probably not going to contain all this information because when we pull a tri-merge credit report, it costs us well over $100, $121 to be exact, because it's so much more in-depth and so much more intuitive as to what's on your credit. So there's a lot of things that you may not see on your personal credit report that's free that we would see on this report. Again, it's going to go through the total trade lines and really just everything and kind of summarize it yet again. It's going to show the inquiries over the last 5 years, even though it's not going to impact you. So just really a lot of information. We won't go through each one of those. Lastly, how long does information report to your credit report? And it's 7 to 10 years. So if you've had some kind of delinquency in the past, that's not going to fall off your credit report for 7 to 10 years. Anytime you've had maybe a 30-day or 60-day late, and statistics will show that over a long lifespan, everyone's going to have 2 to 3 occurrences where they either have financial instability or maybe they just missed a payment because they were out of town, they forgot, they didn't update their email address, or the mail didn't show up. So the reason that you want to have a lot of credit depth is because you can handle some type of small delinquency and not have your credit scores tank. But if you have had a delinquency, the only way to better yourself is to get distance from that delinquency so your scores will come back up. 2 things I want to finish with that are really, really important. These credit repair companies that are out there, they're an absolute scam. Don't sign up for them. They're just taking your money. All they're doing is typing out a form letter and mailing off to the creditors that are contained on your credit report. So avoid them like the plague. You can actually do that yourself, particularly now with artificial intelligence. You can throw your credit report into ChatGPT and it will analyze your credit report for you. It will even type up letters for you to send out to creditors if something's reported in error or you've been delinquent on something. The last thing is that the reason you want to have a lot of different trade lines, not only to increase your credit scores through a credit mix, but if you have a lot of different trade lines and they've been reported for years. For example, on my credit report, I've had one account for 26 years, an American Express card. This is reported on time for the past 26 years. If I was to have that unexpected life event or miss a small payment, it's going to impact my credit. But because I have so much depth and the scores are already high, it's only going to impact me minimally because they can see he's paid all of these debts for 10, 20 years, and this one thing is an isolated incident. And so it's going to affect me, but it's going to be very, very minimal. That's why you want to have the highest credit scores possible, so that if you do have that life event, it's going to knock your credit scores down, but hopefully you'll still be in that range where you can get a conforming loan. Now, if you don't follow me, make sure to subscribe to my channel. I will be going through income, I'll be going through assets, I'll be going through collateral, appraisals, all of these things. So if you found this interesting, forward it to your friends and family, but make sure to subscribe to the channel, and we'll see you on the next one.